Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 134, titled Reversing Delta with the PCP Strategy. We're going to be using a real-life example with Etsy Inc., which trades on the NASDAQ exchange under the ticker symbol ETSY. Now, before we get going, let's just talk a little bit about the two strategies we're going to integrate into this podcast. First, we're going to talk about the PCP strategy, which is a multi-tiered option selling strategy incorporating selling cash secured puts as well as writing covered calls. We're going to also integrate into this podcast a very low risk way of trading these options and option strategies using delta to give us high probability results. So let's get started by talking about and defining the PCP strategy. This is an acronym for put, call, put. So we start with a put trade, we move to a call trade, and we come back to a put trade. So the PCP strategy outside the BCI community is oftentimes referred to as the wheel strategy. I like PCP or put call put because it's more descriptive. In any case, either way, it integrates both strategies. Now, the ultra low risk strategy developed by the BCI team involves selling weekly cash secured puts with deltas of 10. In the case of puts, a delta is indicated with a negative sign because put value is inversely related to share value. So if share value goes up, put value goes down, and vice versa. So we're looking for a delta of 10 or less, or minus 10 or less, when we sell our puts. And our return goal range, a reasonable one using this low risk ultra conservative strategy, would be between 10 and 20% annualized. Now, I said weeklies because I think the annual results can be a little higher than if we use monthlies, but certainly monthlies can be used as well. And in this particular podcast, we're going to highlight the role of delta for both sides of the PCP trade, both for put and calls, assuming our goal is to generate cash flow and continually getting back into a cash position. We're going to be using Etsy in some real life examples here to explain how this works. Now, for those of you who are watching this podcast, you see a screenshot of the PCP strategy. For those of you just listening, I will describe it to you. We have a flow chart right now, which shows on the top left to the top right, where we start our trades by selling an out of the money cash secured put. That's step one of the PCP strategy. Now, if and when that trade is exercised and the shares are in fact put to us, well, that means that we have purchased that stock at a discount from the price of the stock at the time of the put trade. Because number one, we're selling it out of the money put, which means we're agreeing to buy it at a lower price than current market value. And our break-even price point will be the put strike, which was out of the money, minus that put premium. So we are purchasing that security at a discount. Now, moving from the top right, we go to the bottom right, where we take possession of the shares, and then we write a covered call to continue the cash generation approach to using these strategies. Now, if the covered call is exercised and our shares are sold, that will create a large cash position in our account, which can then be used to secure another put. And so we go from the bottom left, where we sell the stock, to the top left, where we started off by then using that cash to secure another out of the money put trade. Let's move now to a real life trade taken from one of my portfolios. On 1/11/21, it's a 1 week trade. So it was the week of the 11/15 expiration. So from 111 to 115, 2021 with Etsy. The initial trade was an out of the money, a deep out of the money 165 strike, which had a delta of 9, minus 0.09 is what you'll see in the option chain, which means that there is a 9% chance of the strike expiring in the money or with intrinsic value. In other words, where we would then take possession of the shares. Now, the minimum bid price was 38 cents. So if we assume that we're receiving 38 cents selling the 165 strike, how much cash will our broker require us to secure that put? Well, the formula is the put strike minus the put premium per share, and that is 165 minus 38 cents, or 164.62 per share. What's our initial time value return? Well, we generate 38 cents on a cost basis of 164.62, and that generates a 1 week return, initial time value return of 0.28%, which will annualize out to 14.7%. What's the probability of success since this strike had a delta of 9? 91%. In other words, there's a 9% chance of the option expiring in the money, which we don't want. So a 91% chance of success. Once again, a 0.28% 1 week return, 14.7% annualized. Now, this was an unusually good week for Etsy because in 2 days in a row, IBD and Motley Fool both came out naming Etsy its stock of the year. So we had a huge upswing in the price of Etsy, which allowed me to roll up that option a few times. For those of you watching this podcast, you could see on the right side of this screenshot the huge price increase the very last week of this trade, which was a 1 week trade. So on Wednesday and Thursday, it went up dramatically, allowing me to roll the option up. I ended up with a net put option credit this week of 0.98 or 98 cents a share. And that annualized out to a 25% annualized return. Now, one of the risks of rolling up twice in the same week is that there could be some profit taking. And even though we're using a delta of 10 or less, there's still a possibility if there's a lot of profit taking that the put could be exercised. I understood that, and in fact, that's what happened. So on Friday, there was profit taking, and it caused the share price to decline to 204.50, which was in the money from the last strike that I sold when I rolled up to the 205 strike. So that 205 strike was in the money or higher than current market value as it relates to puts. Now, I could have bought back the put on Friday and not have those shares assigned to me, but at the time I really liked this stock a lot and I didn't mind taking possession of it. And if I did take possession of it, I had a lot of possibilities. I could sell the stock the next week, particularly if the price went higher, which as you'll see in a moment it did. I could just keep this stock for my long-term buy and hold portfolio. At the time, I really liked this security. Or I could write a covered call, which is what I'm going to show you as it relates to this PCP strategy. But we would reverse the delta. Instead of looking for a delta of 10 or less, we would look for a delta of 90 or higher because we want to go back to a cash position. So if we write a covered call with a delta of 90 or higher, that means that there's a 10%, there's a 90% or greater chance of exercise, allowing us to go back to our cash position. And that's what I did. So let me tell you what I did on the following week, where I now own Etsy at the 205 strike. Remember, I still secured 98 cents per share in option premium after rolling up 2 times. So I sold a deep in the money 1 week, 195 covered call. Now remember, I purchased the stock at 205. So on the stock side, I'm going to be taking a loss, but I generated a very juicy premium of $19.10 per share. and that had a delta of 92. There's a plus sign for delta stats because they are directly related to the price of the stock. Price goes up, delta, then the value of the option also goes up. So in this particular case, a delta of 92 meant that there was a 92% chance of exercise, which is what I was looking to do. If not, I could just write another covered call the next week. But this resulted in a 92% probability that the shares would be sold at the new strike price, and that would still generate a 13.6% annualized return. If the shares are in fact sold, the cash will then be freed up to secure another ultra low risk cash secured put with a delta of 10 or less. So let's look now at the 2-week results if exercised. On the option side, week 1 we had a net credit of 98 cents, and then on week 2 we had an option credit of $19.10, and that resulted in a total net credit of $20.08 per share. Now on the stock side, we had a net debit of $10 because the shares were purchased at the put strike of 205 and sold at the call strike of 195, minus $10 per share. That resulted in a net total trade credit of $10.08 per share. And if we do that on a cost basis of what we paid for the shares, 205, that resulted in a 2-week return of 4.9% or 127.9% annualized. Obviously, this was an unusually good trade result, but I just wanted to show you how it works using the PCP strategy, where we integrate both selling cash secured puts and covered call writing. So to summarize, an ultra low risk option selling PCP strategy can be developed by using deep out of the money cash secured puts with deltas under 10 and deep in the money call options with deltas above 90. Now, even though we're using ultra low risk strategies, we must always be prepared with our exit strategy arsenal, which will help us mitigate losses if the trade turns against us, or to enhance gains, as you saw with rolling up, when those opportunities present themselves. As always, I mention in these podcasts our best and most comprehensive educational product, the BCI package, which has 18 components to it, 6 online video courses with downloadable workbooks, our 6 calculators invented by the blue-collar investor, and 5 of our best-selling books in ebook format, both covered call writing and selling cash secured puts, along with our annual or 13-month premium membership, which provides our members with a watch list of the best securities for option selling, along with a huge educational component right now, over 200 training videos, expanded calculators, free ebooks, and so much more as part of the annual membership. So these BCI package, 18 components, more information can be found on our website, thebluecollarinvestor.com, and click on the link at the top that says BCI package. There's written and video information on this package, which represents, by the way, a 25% discount from purchasing these items individually, which you can do by going to the website, thebluecollarinvestor.com, clicking on the store link, and then you'll have an opportunity also if you'd like to purchase these products individually. Ladies and gentlemen, I want to thank you so much for taking the time to listen to and or watch this BCI podcast number 134, Reversing Delta with the PCP Strategy. Ladies and gentlemen, I hope you enjoyed this presentation, and more importantly, I hope it benefits you. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.